The market just hit a new all-time high, and what is surprising is not just the level, it is how fast we got here. The S&P 500 dropped and then recovered to a new high in under 11 trading days. That has never happened before, going all the way back to 1928. So the real question is simple. Is this a warning sign, or is this actually bullish? Most people look at a move like this and feel uneasy. It feels too fast, too aggressive, almost like something must be wrong. Because in everyday life, things that go up too quickly usually come back down. But the stock market does not always follow that logic. The market is not reacting to what is happening today. It is constantly trying to price in what might happen next. Not next week, not next month, but years into the future. And that is why moments like this can feel confusing, because what looks risky on the surface can actually be a sign of strength underneath. Let's break down what just happened. The market pulled back, sentiment dropped, people got cautious, and then, almost immediately, buyers stepped back in and pushed prices higher. Not slowly, not gradually, but aggressively. This kind of move is called a V-shaped recovery, and historically, it has not been a warning sign, it has actually been a continuation signal. In past cases where the market dropped and then recovered this quickly, the next 100 trading days have often been strong. On average, markets have gone on to gain roughly 20 to 30% from the low. And it does not stop there. When you zoom out even further, similar patterns have led to the market being higher 1 year later, 100% of the time in historical data, with an average gain of around 26%. Now, that does not mean it will happen again, but it does tell you something important. Momentum like this tends to carry. It does not just appear randomly. It usually reflects underlying demand, buyers willing to step in quickly, even when things feel uncertain. But this is where most people get tripped up, because emotionally, buying at all-time highs feels wrong. It feels like you are late, like you missed the opportunity, like the smart move was to buy when things were lower, and now you are just chasing. That feeling is completely normal. But it can also be misleading, because historically, all-time highs are not rare events. They are a normal feature of a growing market. The market spends a significant amount of time near its highs, and over long periods, it tends to keep making new ones, so waiting for a perfect entry point often leads to doing nothing. Or worse, missing large portions of the upside. At the same time, there are real risks. Markets do not move in straight lines. There will be pullbacks, there will be volatility, and there will be moments where sentiment flips quickly. That is part of the process. So the goal is not to ignore risk, it is to understand it without overreacting to it. So what does this actually mean for you? It means your strategy matters more than your timing, because timing the market consistently is extremely difficult. Even professionals struggle with it. Instead, the most reliable approach for most people is consistency, investing regularly over time. Regardless of whether the market feels high or low, this is often called dollar cost averaging. And it works because it removes the pressure of trying to be perfect. You are not guessing the best moment, you are participating in the long-term trend. Some of your investments will happen at highs, some will happen at lows, but over time, it averages out. And what really drives results is staying invested, not jumping in and out, not reacting to every headline, but staying consistent through different market conditions. Because the biggest gains in the market often come during periods that feel uncertain or uncomfortable. So here is the key idea to remember. A fast recovery to new highs feels risky, but historically, it has often been a sign of strength, not weakness. The market is forward-looking, and moments like this usually reflect confidence, even if it does not feel that way in the moment. That does not mean there will not be volatility. There will be, but trying to wait for the perfect time is usually less effective than simply staying consistent, because over the long run, the people who build wealth in the market are not the ones who time it perfectly. They are the ones who stay invested and let time do the work.